You finally have $20,000. Not money somebody gave you, not an inheritance, not a lucky crypto trade. $20,000 you actually saved. And now something strange happens. Saving it was difficult, but deciding what to do with it feels even harder. You know leaving all of it sitting and checking forever probably is not the plan. You know investing exists. You have heard about index funds, real estate, Roth IRAs, 401s, compound growth. But the more videos you watch, the more complicated it starts to feel. One person says buy the S&P 500. Another says real estate. Someone else says Bitcoin. Another says the market is about to crash. So before you buy anything, understand one thing. Your first $20,000 does not need a brilliant investment. It needs a strong financial structure. Because if the foundation underneath the money is weak, investing it will not fix the problem. So here is exactly how I would think about the first $20,000 and 2026. Step 1. Do not invest money you are about to need. The first mistake is believing every dollar you save should immediately enter the stock market. No, imagine you put the full $20,000 into investments Monday. 3 months later, you lose your job, or the transmission dies, or you get a medical bill. Now the market happens to be down 15%. You have created a situation where an emergency may force you to sell an investment at exactly the wrong moment. That is why emergency savings exists. The CFPB says emergency funds can help cover unexpected expenses or loss of income and reduce the need to rely immediately on credit cards or loans. There is no universal number that works for everyone. The amount depends on your situation. Maybe for you that is $5,000, maybe $10,000, maybe more because you have children, unstable income, or expensive responsibilities. The point is not keep exactly 6 months. The point is keep enough liquid that a normal emergency does not force your long-term investment plan to become your emergency plan. That money has a different job. It is not there to make you rich. It is there to stop one bad month from making you poor. Step 2. Check for the expensive leak now. Imagine you have $20,000 saved and $8,000 sitting on a credit card at 24% APR. Before you start calculating whether the stock market might return 8%, look at what is already happening. That card is charging you a very high contractual interest rate. Your investment return is uncertain. That interest charge is not. Investor, Gov specifically recommends prioritizing high-interest credit card debt before investing, because eliminating that debt can be financially stronger and lower risk than trying to earn enough investment return to beat it. So your first $20,000 might not become $20,000 of investments. Maybe part of it destroys high-interest debt. And if that sounds less exciting than opening a brokerage account, good. Building wealth is full of boring decisions that work better than exciting ones. This is also where I would look at your credit. Not because you need an 800 score before investing. You do not. But if high balances, missed payments, or inaccurate reporting are making every future loan more expensive. That is part of the financial foundation too. Pull Experian. TransUnion, Equifax, look for accounts that are not yours. Incorrect late payments, closed accounts reported open, duplicate debts, wrong balances, wrong limits. The CFPB specifically lists those as common credit report errors. If something is genuinely inaccurate, dispute the specific error and provide supporting information. Consumers can dispute errors with both the credit reporting company and the furnisher, but do not dispute an accurate credit card balance because you would rather invest the money. Real credit repair is not pretending debt does not exist. It is making sure your report does not punish you for things that did not happen. Then you fix what is actually yours. Bad credit makes you chase approvals. Strong credit gives you more power to evaluate the terms, and wealth gives you the ability to need fewer approvals in the first place. Step 3. Check whether your employer is offering you money before opening some random investment account because an influencer showed you one. Check your workplace retirement plan. Does your employer offer a 401? More importantly, is there an employer match? Because matching contributions can significantly increase how much enters the account. But every employer's formula is different. The IRS says your plan documents should tell you the matching formula and how much you need to contribute to receive the available match. So do not hear employer match and assume every company matches 100% of everything you contribute. Read your actual plan. For 2026, the employee elective deferral limit for most 401 plans is $24,500. The total annual contribution limit across traditional and Roth IRAs for most people under 50 is $7,500, subject to eligibility rules. You do not have to max either account to begin investing. Do not let large annual limits make a smaller contribution feel pointless. The person putting $250 a month into a retirement account has already solved a problem the person waiting to invest $2,000 a month has not solved yet. They started. Step 4. Understand what actually makes your money grow. Now we get to investing. There are two ideas beginners need to understand: ownership and compounding. When you buy stock, you are buying an ownership interest in a company. When you buy an index fund, you are buying a fund designed to track a particular market index. An index fund may hold all the securities in that index or a representative sample. That matters because instead of betting your entire future on one company, a diversified fund can spread your exposure across many investments. Diversification reduces concentration risk. It does not eliminate the possibility of losing money. Now, compounding is where things become interesting. Suppose you contribute every month. Your original money may earn a return. Then, future returns can act on both your contributions and previous growth. At first, this feels painfully slow. The first $10,000 mostly you. The next $10,000 is still mostly you. Eventually, if markets cooperate over a long period, the capital itself begins doing more of the work. That is why everybody talks about time. Not because investing for a long time guarantees you become rich. It does not. Because compounding needs time before the numbers become large enough to feel powerful. Your first $20,000 is a seed, not the finish line. Imagine you eventually invest $1.000 a month. At a hypothetical 8% average annual return, your account could cross the first $100,000 in roughly 7 years. The next $100,000 can arrive faster because now the assumed return is acting on a larger balance. But understand what I just said. Hypothetical, 8% is not promised. The market does not owe you 8% next year. Some years can be strongly positive. Some can be negative. Some can go almost nowhere. That is why the important part is not building a plan that only works if every year's good. Build one that you can continue through bad years too. Step 5. So what should you actually buy? This is where beginners usually make investing unnecessarily difficult. They look at the companies that recently exploded in value, and they think, I missed that one. I need to find the next one. That is a dangerous game. Past performance does not guarantee future results. Yesterday's biggest company can become tomorrow's average company, and a company nobody cared about 10 years ago can become enormous. You do not know in advance. Neither do I. That is one reason diversified index funds can be useful for long-term investors who do not want their future to depend on identifying a handful of winning companies. An index fund is not automatically safe, and it is not automatically cheap. You still need to understand what index it tracks, the expenses, risks, and what the fund actually owns. But the idea is simple. Instead of asking which company will win, you can own exposure to a broader group and allow the portfolio to participate across many companies. That is less exciting. That is often the point. Stocks or real estate? Now comes the question everybody asks once the savings account starts getting serious. Should the first $20,000 go into stocks? Or should you keep saving for property? The answer depends partly on what kind of life you want around the investment. Stocks and diversified funds have a much lower operational burden. You can automate contributions. You do not answer tenant calls. You do not replace roofs. You do not pay a plumber because something started leaking Saturday night. You also have relatively high liquidity compared with directly owned real estate. Real estate gives you something stocks normally do not give the ordinary unleveraged investor: direct control over the asset and the ability to use mortgage financing. But that leverage cuts both directions. If you buy a $300,000 property with borrowed money and the property increases in value, leverage can amplify the return on your equity. If the property falls, leverage can amplify the damage to your equity too. And rent is not profit. Mortgage, taxes, insurance, vacancy, repairs, maintenance, management, transaction costs, they all exist. Real estate can absolutely build wealth. So can stocks. You do not need to turn investing into a sports rivalry. You can eventually own both. For many beginners, the stock market is simply easier to start with because you can begin with a small amount and add to it continuously. Property usually requires more capital, more underwriting, more reserves, and more responsibility. The better investment is not automatically the one somebody online claims produced the highest return. It is the one whose bad years you can actually survive. Step 6. Automate the boring part. Once you decide what amount you can invest consistently, automate it. Maybe $200, maybe $500, maybe $1,000. Investor. Gov defines dollar cost averaging as investing equal portions at regular intervals regardless of market ups and downs. This does not guarantee profit. It does something psychologically useful. It removes the monthly conversation. You no longer wake up on the first day of every month asking, is today the right time? The money moves. Market up, money moves. Market down, money moves. Market boring, money moves. Your income grows, increase the amount. That is how a small investment starts becoming a serious system. The 3 mistakes that can destroy the plan. The first is procrastination. You tell yourself, I need to learn a little more. That becomes, I'll start after the market drops. Then I'll start after the election. Then after the recession. Then somehow you were 5 years older and still researching how to begin. Learn enough to understand what you own, its risks, fees, and your time horizon. Then start at a level you can sustain. The second mistake is chasing excitement. Somebody posts a stock that doubled. A coin explodes. An investment opportunity has the words, "You can't miss this." Suddenly, the diversified portfolio feels boring. Good. Investing does not have to entertain you. If you want to buy individual stocks and you understand the risks, that is your decision. But do not confuse speculation with the foundation of your financial future. And mistake number 3 is panic. Your $50,000 portfolio becomes $42,000, then $38,000. Everything on television sounds terrible. You sell because watching the loss hurts. Then the market eventually recovers without you. A market decline does not automatically mean your original long-term plan was wrong. It means investing includes risk. The question is whether your portfolio matched your risk tolerance before the decline arrived. What I would do with the first $20,000, I would not start with, what stock should I buy? I would start with, what job does each dollar need to do? Some might protect you from emergencies. Some might eliminate expensive debt. Some might go toward a workplace retirement plan. Some might fund an IRA if eligible. Some might enter a taxable brokerage account. The exact split is personal. But the order matters. Stability first, expensive leaks next, then long-term investing. And credit belongs in that foundation too. Because it makes very little sense to spend years building an investment account while ignoring a credit report filled with genuine errors or carrying revolving balances that keep making future borrowing more expensive. Build both sides. Assets going up. Expensive liabilities going down. Credit becoming cleaner and stronger. Emergency savings giving you breathing room. Then let time work. Your first $20,000 is not powerful because $20,000 is some magical number. It is powerful because this is often the first time you have enough financial margin to start building several layers at once. Protection, debt reduction, credit strength, retirement, investments, and eventually options. The goal is not to become somebody who has $20,000 invested. The goal is to become somebody with a financial system that knows what to do with the next $20,000. And the next one. And the next one. Until one day the money you built starts doing enough work that your paycheck is no longer carrying your entire financial life by itself. That is when the game starts changing. Not when you find the perfect investment. When you finally build a system strong enough to keep investing when life stops being perfect.